In this section, I'm going to consider how you can go about finding interesting looking shares to include in your watch list and obviously ultimately in your portfolio. And here we borrow a term from the mining industry. We talk about prospecting for interesting looking shares. And there are basically 5 methods of prospecting. The first method is to study the financial media, the press, to study internet websites that give financial reports, and to listen to radio and television programs that report on what's going on with listed shares. From these media sources, you will often find interesting looking shares that you can include in your watch list. So you need to study them on a regular basis. The second method is to look at the companies that are listed on the JSE from a fundamental perspective. And here you are particularly looking for shares which are in their closed period. Now the closed period for a company, for a listed company, begins when their financial year ends. And it ends when they publish their financial statements, usually about 2 or 3 months later. During that period, you can sometimes find a company that is undervalued, where the marketplace is still not understanding the true value of that company. If you can establish that that company is undervalued, you have an opportunity to buy it before the rest of the market realizes their mistake and bids the share price up. So you need to look for the company's financial year ends, find out when they are, and study the companies from a fundamental perspective during their closed period. The third method is to use your technical analysis or charting software to scan through the market for shares that are oversold to a certain level. Now you may not know what an overbought oversold technique is, and you can look it up obviously in your glossary and get a detailed explanation. But there are many technical indicators in your software that would enable you to scan through and look for shares which are possibly or potentially in a good buying situation. And you need to start becoming a master of those different methods, because if you scan through the market for shares that are oversold to a certain extent, then clearly you can define a short list of shares and continue your analysis from there. The fourth method is to look for tips and rumors that are going around in the marketplace. Sometimes when you're at a braai or some other social event, somebody mentions a company during conversation, and then you might find a lead for a company that is interesting enough for you to put on your watch list. Obviously, you must be very careful here. You know, there's an old Wall Street saying that where there's a tip, there's a tap. And what that means is that often the financial director or the managing director of a company will know that there's some bad news coming out about his company, so he spreads a rumor that there's a takeover. People buy up the share on the rumor, and then obviously in due course the takeover doesn't materialize. What does materialize is the bad news, and everybody's left holding the share. So you have to be careful of that situation. My advice to you is to just check that you would have bought the share anyway if you didn't get the tip. So do your homework, and if your homework conforms with the tip, then you can go ahead. But if your homework points in the opposite direction, be very, very careful. So tips, that's the fourth method. The fifth method is to move from the general to the specific. Start by analyzing the entire world economy. Look at where various commodities are going, gold, platinum, oil, and things like that. Look at where currencies are going. Is the dollar going up or down against the euro, against the yen, against the Swiss franc? Is it going up or down against the rand? And then look at individual economies, like the American economy. Is it growing or shrinking? Are interest rates going up there or down? Look at the Chinese economy. Look at the European economy. Are they escaping from their sovereign debt crisis? What is happening worldwide? And that will tend to point up certain industries which are in South Africa which could do well in the future. Then, of course, once you've got to that point, you need to analyze those industries and look for specific companies that could be doing well. Once you have the specific company, you can then focus on the timing of your transaction. So by that method, you move from the general analysis of the world economy down to an analysis of the South African economy, and finally down to an analysis of a specific industry and listed company. Those are the 5 methods of prospecting for interesting looking shares. Let us go through them again. The first method is to look at the financial press, the financial media. The second method is to look at the fundamental situation and focus particularly on the closed period. The third method is to use your technical analysis or charting software to scan for shares which are oversold to a certain extent. The fourth method is to listen for tips and rumors that are in the marketplace about specific companies. And the fifth method is to move from the general to the specific, beginning with an analysis of the world economy and focusing down onto a specific share on the Johannesburg Stock Exchange. Those are the 5 methods of prospecting for interesting looking shares. Your prospecting should have left you with a group of interesting looking shares. And now you need to take that group of shares and subject them to a series of criteria to determine whether they are good enough, whether they are worthy of going onto your watch list and obviously subsequently into your portfolio. So what are these criteria? Well, the first criteria should possibly be the industry that the company comes from. And here we would advise beginners to stay away from commodity shares. Companies which trade a commodity, which mine a commodity and sell it on the international markets. These companies tend to be very volatile because they are entirely dependent on the price of that internationally traded commodity. So what am I talking about here? I'm talking about gold shares, I'm talking about platinum shares, I'm talking about oil shares like Sasol, even companies like Sappi, which trade in coated wood-free paper on the international markets. These types of shares can be very volatile and difficult to predict. You might also want to consider whether the company is, for example, a retailer, a wholesaler, or in the service industries. This can make a huge difference to its prospects. So those types of criteria are very, very important. Your second criteria should probably be the volume traded on the share on a daily basis. How many shares are changing hands in that company every day? We have a rule of thumb that we use here. We say that you should not buy a share unless there is at least 3 times what you want to buy being traded in that share every day on average. So for example, if you want to buy 10,000 rands worth of a share, you should see 30,000 rand per day passing through that share on average. If you choose a share which is thinly traded or where there is not enough volume, you will have extreme difficulty in selling it when you want to. So that could interfere with your stop loss strategy. So volume traded is very, very important. Your third criteria might just be the size of the company. How big is it? Do you want to concentrate on big blue chip shares, or are you more interested in penny stocks and speculative shares? Again, to begin with, we would recommend that you stay with the blue chip shares which are heavily traded and which are big, solid companies that have been around for years and years. So size is determined by the company's market capitalization. If you do not know what that means, look it up in the glossary. There's a very good detailed explanation. Your next criteria might be the dividend yield. As we discussed in our previous sections, the dividend yield can be a very good indicator of whether the company is out of favor with the big institutions, especially if it's a blue chip. Now obviously many shares on the JSE do not pay dividends at all and therefore not have a dividend yield, and that could also be a consideration. Your next criteria could be the company's exposure to unions. Does it have a large unskilled or semi-skilled workforce? As we have seen in South Africa, if a company is highly exposed to union action, to strikes, that can be a major factor in its share price and obviously in its profitability. The next criteria could be, is the company exposed to the rand? The rand is a very volatile emerging market currency that goes up and down all the time. Companies which import products from overseas are very susceptible to the rand weakening. On the other hand, companies which export will benefit from a weakening rand and will have a difficulty if the rand is strengthening. So you need to consider the susceptibility of the company to the rand. That is a vital criteria. And you can have many other criteria. You could, for example, have a criteria which is based purely on technical analysis techniques, like the overbought, oversold, and momentum, and stochastic, and so on. You could have criteria which are based on the company's earnings track record. Has its profits been rising steadily over the years? So all these criteria will first of all dictate to you whether the company is worth including in your watch list, and then finally, obviously, whether it is worth including in your portfolio. And really what you are studying in studying the share market is to develop a set of criteria that will work for you in selecting the right shares at the right time.